Today, we're diving into a question I get asked all the time, and honestly, one I used to Google constantly when I was just starting out. How often should you apply for credit cards? Because if you're anything like me, once you start learning about sign-up bonuses, category multipliers, and all the different ways to earn rewards, it gets really tempting to keep applying for more and more cards. But the truth is, how often you apply can make or break your long-term strategy. So in this video, I'm going to break down exactly how to think about application timing, whether you're brand new to credit cards or deep into the game. I'll walk you through how credit score factors actually work behind the scenes, what the banks are really looking for, and how different issuers have different rules you need to know before you apply. I'll also be giving you my personal take based on my own journey, what I did right, what I probably should have waited on, and how I think about timing my applications now that I have 6 cards in my wallet and a long-term strategy in mind. So if you're trying to figure out when to apply for your next card without getting denied, stick around. Let's start by talking about the 5 key factors that make up your credit score and how to get the most value out of each one. Mastering these will not only boost your score, but also give you the best shot at getting approved for new credit cards. The first and most important factor making up 35% of your credit score is your payment history. And honestly, this one's pretty straightforward. Just pay your bills on time and in full every single month. Now, when I say on time and in full, what I really mean is make sure you're paying your full statement balance by the payment due date every single month. If you don't, you risk having a late or missed payment show up on your credit report, and that can seriously hurt your score, even if it only happens once. A single missed payment can tank your credit score by 100 points or more and can actually stay on your credit report for up to 7 years. The good news is late payments typically aren't reported as late, unless you're 30 or more days overdue. So if you're still within that 30-day window, you can usually just pay the lender a late fee and avoid it ever getting reported to your credit report. To avoid the headache altogether, what I do and what I'd recommend you do too is set all your credit cards to auto pay your full statement balance by your payment due date, and you'll never have to worry. Now, the second biggest factor in your credit score, making up 30% of it, is your credit utilization. This is one of those areas that trips a lot of people up, so I'm going to break it down as clearly as I can and show you exactly how to use it to your advantage. First, let's define it. Your credit utilization is the percentage of your credit limit that you're currently using. And one of the first things you need to understand is how to calculate it. All you have to do is take your statement balance on your credit card, divide it by the credit limit on that card, and then multiply by 100. For example, if your card has a $10,000 credit limit and your statement balance is $300, that's a 3% utilization on that card. Now, 2 quick things to note here. First, each of your credit cards will have its own individual utilization. And second, all of those get combined to calculate your overall utilization, which means your total balances divided by your total credit limits across every card. That overall number matters just as much, so it's important to keep track of both. From what I've seen personally, and based on tons of feedback from others too, it seems that keeping your utilization in that 1 to 2% range tends to give your score the biggest boost. It's not a hard rule, but that range consistently seems to be the sweet spot for maximizing your score. A 0% utilization is totally fine too, especially if you're just trying to play it safe. But having a small balance reported, like just 1%, can actually give your score a slightly bigger boost than showing 0% every month. Either way, as long as your utilization gets reported as a very low number, you're in great shape. Now, just to be clear, when I talk about having a small balance reported to the credit bureaus, I don't mean you should carry a balance past your due date. You should always pay off your cards in full. I'm specifically talking about the balance that gets reported to the credit bureaus, which happens on your statement closing date, not your payment due date. I actually made a whole video breaking this down, how to pay off your card the right way, exactly when to pay, and how to avoid interest. So if you want a full walkthrough, go check that one out, linked above. So here's where timing really matters. Your statement closing date and your payment due date are not the same, and the difference between them is usually about 25 days. Understanding the difference between those 2 dates is what really helps you figure out how to report only 1 to 2% utilization every month while still actually using your cards. So let me quickly show you what that looks like. Let's say you have a credit card with a $10,000 credit limit. That means 1% utilization would just be $100. And that's the amount you'd want showing on your statement closing date. So even if you spent $9,000 that month, set a reminder to pay it down to $100 a couple of days before the statement closing date, and boom, only $100 gets reported. That shows 1% utilization instead of 90%, and your credit score stays in great shape. Then, once the statement closes, that $100 becomes your official statement balance, and that's the amount you want to pay in full by the payment due date, ideally by setting up auto pay so you never miss it. And one more thing, never just pay the minimum balance on a credit card. It's a super misleading term. If you only pay the minimum, you'll still get charged interest on the rest of your balance. So always pay the full statement balance to avoid interest, protect your score, and just keep things simple. The last 3 credit score factors are going to be much quicker to explain, starting with your length of credit history, which makes up 15% of your score. This one's pretty simple, but it takes time. And honestly, there's not a whole lot you can do here. Basically, the longer you keep your cards open, the better. And the easiest way to do that is by simply keeping your oldest credit card accounts active and not canceling them even if you don't really need them anymore. Now, if your oldest card has an annual fee you no longer want to pay, don't rush to cancel it. See if your issuer will let you downgrade it to a no annual fee version instead. Then just put a small charge on it once in a while, like a streaming service or a recurring bill, just to keep it active and help maintain your average age of accounts. Canceling your newer cards or even business cards typically won't affect your credit age much. That's why I usually recommend holding off on adding premium cards to your setup too early. If they don't have a good downgrade path and you end up needing to cancel one, you don't want it to be one of your oldest accounts. So bottom line, the longer your credit accounts stay open and in good standing, the better it is for your score. Play the long game here. The fourth factor is going to be new credit, which makes up 10% of your score, and the main thing this covers is hard inquiries. This is actually the part that ties most directly into today's topic: how often should you apply for new credit cards? Now, right away, the fact that this only makes up 10% of your credit score should already tell you that you don't need to stress too much about applying too quickly. Of course, as long as you're being responsible about it. I know hard inquiries sound scary and a lot of people get nervous about them, but in reality, they don't have a huge impact on your overall credit score. Personally, I've only seen my score drop maybe 5 to 10 points after applying for a new card, and most of the time, my score rebounds right back to where it was when I first applied within a billing cycle or 2. In fact, it usually ends up even higher than before I applied just by using the new card responsibly. So don't let the fear of hard inquiries stop you from applying for a card that genuinely fits your strategy. Lastly, the fifth and final factor that makes up your credit score is your credit mix. And just like new credit, this one accounts for 10% of your score. Credit mix simply refers to the different types of credit accounts you have. That could be credit cards, auto loans, student loans, mortgages, basically any kind of borrowing. Lenders just like to see that you can manage a variety of credit types responsibly. That said, this definitely doesn't mean you should go out and take on a new loan just to improve this factor. For one, it's a small part of your overall credit score. And more importantly, loans usually come with interest, so taking on debt you don't actually need just for the sake of a few points on your credit score isn't worth it. This is one of those factors that tends to improve naturally over time as your financial life evolves, so don't stress it. Now, while we're on this topic, a lot of people wonder, how exactly does applying for or getting approved for a new credit card impact your credit score? Let's start with the potential negatives. Anytime you apply for a new credit card, it usually triggers a hard inquiry on your credit report. That's the main short-term ding to your score. But as I mentioned earlier, it's really nothing to stress about. In most cases, it's just a small drop of 5 to 10 points, and your score typically rebounds within a couple of billing cycles, sometimes even higher than where you started. Also, when you open a new card, your average age of accounts will go down a bit. That's normal. It's not ideal, but it's also not a huge deal, especially if you're not closing older cards and you're thinking long term. But here's the upside, and there's a lot of it. Getting approved for a new card will increase your overall credit limit, which means your credit utilization will likely go down as long as your spending doesn't go up. And lower utilization is a great thing for your score. You'll also be adding to your credit mix, which can help your score slightly over time. Plus, you now have another opportunity to build positive payment history by paying that new card off in full and on time each month. And of course, let's not forget, you're most likely getting access to a welcome offer, new perks, and bonus categories that can help you earn more rewards and hit your financial goals faster. So to quickly recap this whole credit score section, your payment history and credit utilization are the 2 biggest factors. Together, they make up 65% of your score. That's where you want to focus first. The other 3, credit age, new credit, and credit mix, matter too, but they'll improve naturally over time. So don't rush the process. Building a great credit score is a long game. Be consistent, stay responsible, and that 800 plus score will come with time. Now let's dive into the next part of the video, covering credit card application rules. There are a lot of different rules out there, so to keep this simple and actually useful, I'm going to focus on the 5 major credit card issuers: American Express, Chase, Capital One, Citi, and Bank of America. Each of these lenders has its own rules and set of restrictions around how often you can apply, how many cards you can have, and what you need to be approved. And while I'll break down the most important ones to know, this still won't be an exhaustive list. So I definitely still recommend doing your own research too before you apply for anything new. Let's start with Chase, because they've got one of the most well-known and strictest rules in the credit card space, the 524 rule. This rule states that if you've opened 5 or more personal credit cards across any issuer in the past 24 months, you'll automatically be denied for most Chase credit cards, even if your score is excellent. So if you're over that limit, it's usually best to hold off on applying with Chase until you're back under 524. Now, business credit cards generally don't count against your 524 status as long as they don't show up on your personal credit report. But keep in mind, Chase's own business cards are still subject to the 524 rule, meaning you can't get them if you're already over 524. On top of that, Chase also has some specific welcome offer rules you'll want to keep in mind. For the Freedom cards, if you've earned a welcome offer on a specific Freedom card within the last 24 months, you won't be eligible for another welcome offer on that card just yet. And you can't have the card open to qualify again. So if you still hold the card, you need to cancel or downgrade it first before becoming eligible for another bonus. For the Sapphire cards, it's a 48-month rule. So if you've gotten a Sapphire Preferred or Reserve bonus in the last 4 years, you're not eligible for another just yet. You also can't hold more than one Sapphire card at the same time. So it's either the Preferred or the Reserve, not both. They also have a 230 rule, meaning you can only be approved for 2 Chase credit cards every 30 days. Now, unlike some issuers, Chase does not cap you on the number of credit cards that you can have with them, but they do limit you on the total available credit they're willing to give you. So that could still impact your chances of getting approved for additional cards, especially if you already have high limits across multiple accounts. So those are the biggest Chase rules to keep in mind. Like I said, there are probably some more rules out there that I missed, but these are the main ones you'll want to keep track of. Let's move on to AmEx next, starting with their 4 to 6 rule. While this rule is technically an unofficial guideline, historically, most people can hold up to 4 or 5 AmEx credit cards at a time, and in some cases, a 6th might get approved. But keep in mind, this only applies to AmEx cards with preset spending limits, like the Blue Cash Everyday, Delta SkyMiles cards, Hilton Honors cards, and so on. On the other hand, AmEx charge cards like the Gold or Platinum don't count toward that limit. They fall into a separate bucket entirely, with AmEx typically allowing most people to hold up to 10 charge cards at once, but realistically hitting that number is pretty rare. AmEx also has the once per lifetime rule when it comes to welcome offers. That means you can only get the welcome bonus on each individual AmEx card once in your lifetime. So if you've had the AmEx Gold before and already got the bonus, you wouldn't be eligible for it again, even if you cancel and reapply years later. AmEx also added another layer to this called the family rule for certain cards. Basically, if you've had a card from a specific family like the Platinum, Gold, or Green, you might be ineligible for welcome offers on other cards in that same family. For example, if you have or previously had the AmEx Platinum, you may not be eligible for the bonus on the Gold or Green cards. And if you've had the Gold, you likely won't qualify for the Green either. They have a 1 in 5 rule, which says you can only be approved for 1 credit card every 5 days. But that doesn't apply to charge cards, just credit cards with preset limits. And finally, they've got a 2 in 90 rule, which limits you to 2 credit card approvals every 90 days. Now let's talk about Capital One. Unlike Chase or AmEx, Capital One's rules seem to be a bit more flexible and honestly a little unpredictable. Most of their application rules are what people refer to as soft rules, meaning they're not always enforced the same way every time. One rule we've seen pretty often is that Capital One tends to limit approvals to 1 personal and 1 business card every 6 months. Again, this isn't always enforced, but it's something to be aware of if you're planning back-to-back applications. Another unofficial rule, at least in the past, was that Capital One might limit you to just 2 personal credit cards at a time, especially with their main lineup like the Venture or Venture X. This one seems hit or miss today, but it's been reported enough times that it's worth keeping in mind. Lastly, there's a 48-month rule related to welcome offers. If you've had a specific Capital One card before and got a welcome bonus on it, you may need to wait 48 months or 4 years before becoming eligible to earn that bonus again. Now let's go over to Citi. They've got a few rules to keep in mind, some clearer than others. First, Citi limits welcome offers to once every 48 months per card. That means if you've earned a bonus on a particular Citi card, you'll have to wait at least 4 years before reapplying and being eligible for that bonus again. Then we have what people call the Citi 865 rule. It basically means you can't apply for more than one Citi card every 8 days and no more than 2 Citi cards every 65 days. And lastly, Citi's business cards come with their own restriction. You're limited to 1 business card application every 90 days. And then the last lender we'll talk about in this section is Bank of America. And while they don't have as many strict rules as some other issuers, there are still a few things to keep in mind. First, there's the 2-3-4 rule that says you can only be approved for 2 Bank of America cards every 2 months, 3 Bank of America cards every 12 months, and 4 Bank of America cards every 24 months. This mainly applies to personal cards. Business cards may follow different standards. They also seem to have a 3-12 or 7-12 rule, which looks at how many cards you've opened across all issuers, kind of like Chase with their 524. Basically, if you have a Bank of America deposit account, you may be denied if you've opened 7 or more cards in the last 12 months. And if you don't have a Bank of America deposit account, that limit drops to 3 new cards in the last 12 months. Lastly, there's a 24-month rule on some individual cards. For example, with the Alaska Airlines card, you might not be eligible if you currently have it or have had it in the past 24 months. That means you need to wait 24 months after opening or canceling the card before applying for it again. This rule may also apply to some Bank of America business cards, but enforcement can vary by product and applicant. Hopefully I didn't put you to sleep there, but now you've got a solid reference you can come back to anytime with the key application rules from some of the biggest credit card issuers out there. All right. Now let's get into the part you've probably all been waiting for, my take on how long you should actually wait between credit card applications. At the end of the day, I think most people fall into one of 3 groups. And my recommendation for how long to wait between credit card applications depends on which group you're in. So if you're just starting out with credit cards, my advice is to keep it simple. Just focus on getting 1 card in your first year, maybe 2 if you're feeling confident after 6 months. But ideally, you should hold that first card for at least 9 to 12 months before applying for another. At this stage, it's not about chasing rewards, it's about building your credit history the right way. That means always paying on time and keeping your utilization low. As for your first card, a beginner-friendly option like the Discover It or the Chase Freedom Rise can be a great starting point. If those don't work out, you could also look into getting a student card like the Discover It Student or the Capital One Saver Student, or even a secured card like the Capital One Platinum Secured or the Discover It Secured. Whatever you choose, just remember, rewards will come later. Your job right now is to build trust with lenders. Now, if you're in that intermediate stage of your credit card journey where you've already built a solid foundation and you're starting to piece together a reward setup, I'd say applying for a new card every 3 to 6 months is a pretty safe and realistic pace. Personally, I didn't apply for a new card every 3 months like some people do. I've taken a more gradual approach and currently have 6 credit cards, which has worked really well for me. That said, if your goal is to build your setup quickly, the 3-month guideline can make sense for a couple of reasons. First, most welcome offers require you to hit a specific spending requirement, like $4,000 in the first 3 months of opening the account. Giving yourself that full-time window helps make sure you meet the requirement without overspending. Second, spacing out applications by at least 3 months gives your credit score time to recover. After a new application, you'll usually see a small dip from the hard inquiry and lower average age of accounts like I mentioned earlier. But if you're using your card responsibly, paying on time and keeping utilization low, your score typically bounces back within 1 to 2 billing cycles, and in many cases ends up higher than where it started. So while 3 months is probably the fastest pace I'd recommend, there's definitely no rush either. Waiting longer between applications can actually help your approval odds, especially as your credit profile keeps getting stronger. Lastly, if you're in that more advanced stage of the credit card game where you've got a strong credit profile, high income, and a good amount of natural spending, you can absolutely apply faster. Applying for a new card every 1 to 2 months can be manageable as long as you have a plan and stay disciplined. That said, you need to be careful. Just because you can apply more often doesn't mean you always should. Make sure you're not biting off more than you can chew when it comes to welcome offer spending requirements. Overspending just to hit a bonus completely defeats the purpose. You also want to avoid getting blocked by issuer rules, which is why having a plan matters. The last thing you want is to accidentally lock yourself out of a card you are planning to get down the line. At the end of the day, credit cards can be a powerful tool, but they can also cause a lot of damage if you're not using them responsibly. So whatever your pace is, make sure it's backed by a clear strategy, strong spending habits, and a long-term mindset. Ultimately, everything comes down to getting a new credit card when you actually need one. Maybe you've got a big trip coming up and want to earn a welcome bonus to help cover flights. Or maybe you're trying to stay under 524 to keep your Chase options open, so it makes more sense to hold off or consider a business card that won't show up on your personal credit report. Same goes for big spending seasons. If you've got a major expense coming up like a wedding, home repairs, or even tax season, it might make sense to grab a new card to maximize your return on spend. Or maybe you're totally happy with your current card setup and none of this really applies to you right now. That's the beauty of credit cards. It's a very personal game. There's no one-size-fits-all answer here, but hopefully this gave you a little more clarity and confidence heading into your next application. And if you're not sure how many credit cards you should even be aiming for in the first place, go ahead and click into this video next. As always, if you enjoyed the video, go ahead and give it a like, and if you want more content like this, hit that subscribe button. Appreciate you watching, and I'll see you in the next one.